Every 4 years, people say the same thing about Bitcoin. They say this cycle is different. They say the volatility is too high. They say it is too risky for serious money. And every 4 years, they are wrong. But what is happening right now in 2026 is genuinely different. Not because of the price, because of who is buying it, who is building on it, and what the smartest financial minds in the world are quietly saying behind closed doors. The fundamentals of Bitcoin have never been stronger, and most people have absolutely no idea. Welcome to Mr. DJ Finance. Let us get into it. Let us start with the macro picture because that is where everything begins. The Federal Reserve has maintained a hawkish stance for longer than most analysts expected. The balance sheet reduction continues. Interest rates remain elevated, and risk assets across the board have been under pressure. Portfolio managers who loaded up on tech stocks and speculative plays are sitting on painful drawdowns. The traditional 60-40 portfolio is struggling. And in this environment, something very interesting is happening. The correlation between Bitcoin and traditional risk assets is breaking down. For years, critics said Bitcoin is just a leveraged bet on the stock market. When stocks go up, Bitcoin goes up more. When stocks go down, Bitcoin goes down more. But the data in 2026 is telling a different story. Bitcoin is beginning to decouple. Not perfectly, not every day. But structurally, over longer time frames, the correlation is weakening. And that is exactly what institutional portfolio managers have been waiting for. Here is why that matters. The entire value proposition of adding Bitcoin to a portfolio is diversification. If Bitcoin moves in lockstep with the S&P 500, then there is no point adding it. You already have that exposure. But if Bitcoin offers uncorrelated or low correlated returns, suddenly it becomes one of the most attractive assets a portfolio manager can hold. It improves your risk-adjusted returns. It reduces your overall portfolio volatility over time, even though Bitcoin itself is volatile. That sounds like a contradiction, but it is basic portfolio theory. An asset that is volatile on its own but uncorrelated to everything else in your portfolio actually makes the whole portfolio safer. And the smart money understands this. Now let us talk about what is happening on the institutional side, because this is where the real shift is taking place. CalPERS, the California Public Employees Retirement System, the largest public pension fund in the United States, has been increasing its exposure to digital assets. When a pension fund that manages hundreds of billions of dollars in retirement savings for teachers and firefighters starts taking Bitcoin seriously, that is not speculation. That is a structural change in how the financial system views this asset. And CalPERS is not alone. Pension funds and sovereign wealth institutions across the globe are quietly building positions either directly or through ETF allocations. Then look at MicroStrategy. The company now holds over 700,000 Bitcoin and has been included in the S&P 500. Think about what that means. Every single index fund that tracks the S&P 500 now has indirect Bitcoin exposure through MicroStrategy. Your retirement account, your 401k, your pension, if it holds an S&P 500 index fund, you already own Bitcoin, whether you know it or not. That is how deeply embedded this asset has become in the traditional financial system.